In this segment of Week 4, we're going to continue our discussion of globalization and international investing, and then pivot into a discussion of hedge funds. These are topics that tend to sound a bit intimidating at first, but once we break them down, you'll see that they follow many of the same principles you already understand with domestic investing. The thing to focus on as we go through this material is how global markets interact, how risk behaves when markets are under stress, and why some investment structures exist largely for sophisticated investors rather than for everyday individuals. Global markets and diversification. U.S. stock exchanges account for roughly 60% of global equity markets. That means when you invest only in U.S. stocks, you are heavily concentrated in one geographic region, even though that region does tend to be dominant. Emerging markets play a different role. These economies are still developing, and their stock market growth often outpaces their GDP growth during expansion periods. That can create opportunities, but of course, it also introduces volatility. A key question investors often ask is whether diversification benefits hold up during bear markets. The short answer is that diversification helps most during normal conditions, but it becomes far less effective during a global crisis. The October 1987 crash. This slide shows regional market behavior during the October 1987 crash, which coincidentally was the very first crash I experienced as a young and new investor. What stands out is that markets around the world declined together. This illustrates an uncomfortable truth for investors. When panic hits global markets, correlations tend to spike. Assets that usually move independently suddenly all seem to panic together. That's important because it challenges the assumption that simply investing internationally will always protect you from severe losses. 2008 proved this all over again. More recent historical data, such as the impact of coronavirus on the stock markets, reminds us that market crashes are not simply theoretical events. They are real and recurring phenomena. Studying past crises gives us perspective and helps us understand how markets behave when they're placed under stress. One of the most valuable skills one can develop as an investor is the ability to separate short-term fear from long-term trends and investment fundamentals. As is often shown time after time, the patient investor is the successful investor. Conclusions on international diversification. A fully passive investment across all countries would not have meaningfully reduced risk during these recent crises. Currency hedging also offers limited protection once markets enter full panic mode. U.S. market crashes tend to be systemic events that ripple globally and cannot be diversified away in the short run. That said, international diversification still offers modest benefits during normal market conditions. The takeaway here is balance. Global investing is not a magic shield, but it can still improve portfolio efficiency over time. Risk factors in international investing. International investing introduces additional layers of risk beyond what we would see domestically. These risks do not automatically make international investing bad, but they do require thoughtful consideration. Understanding these risks allows investors to make informed decisions rather than reacting emotionally to headlines or short-term performance. Exchange rate and country-specific risk. Exchange rate risk occurs when changes in currency values affect investment returns. Even if a foreign stock performs well, a weakening currency can erase gains once converted back to US dollars. Country-specific risk includes political instability, regulatory changes, and economic disruptions unique to a particular nation. These risks are harder to predict and often remain outside the control of individual investors. Introduction to hedge funds. Hedge funds are often misunderstood and sometimes even romanticized. They are not simply better versions of mutual funds. Instead, these are fundamentally different investment vehicles designed for a fairly narrow investment audience. Hedge funds versus mutual funds. Transparency and strategy. Mutual funds operate under strict regulatory requirements. They must disclose portfolio holdings publicly and allow limitations on leverage, short selling, and the use of derivatives. Hedge funds, on the other hand, provide information only to a small number of high net worth investors and consequently face far fewer restrictions. This flexibility allows hedge funds to pursue aggressive strategies, but it also increases both risk and opacity. Liquidity and fees. Mutual fund investors can typically redeem shares on demand, and they pay relatively low fees. Hedge funds often impose multi-year lockup periods and charge both management fees as well as incentive fees, commonly around 20% of the gains above a stated benchmark. These structures align manager incentives with performance, but they can also significantly reduce net returns to investors. Funds of funds. A fund of funds invests in multiple hedge funds in order to provide diversification. While this may sound appealing, it does add another layer of fees. These structures gained a very poor reputation after many funds of funds were exposed to major investment fraud as part of Bernie Madoff's operation. This highlighted how complexity can obscure risk rather than reduce it. Madoff operated a massive Ponzi scheme by paying existing investors with money from new investors. His reputation and industry standing at the time allowed this manner of fraud to persist for years. This case reminds us that credibility does not equal legitimacy. Even sophisticated investors can be misled when transparency is lacking. Warning signs and regulatory lessons. Several red flags were actually present. Returns were unusually stable. The audit firm used by Madoff lacked credibility. Assets were also held internally rather than with an independent third-party custodian. The lesson here is simple but powerful. Complexity and secrecy should always raise questions, not increase confidence. This brings us to the end of this segment. If anything here raised questions or perhaps sparked additional curiosity, that's a good thing. Investing is not about memorizing facts or techniques or formulas. Instead, it's about understanding how systems behave and learning how to think critically about both risk and return. Take a few moments to reflect on how globalization, diversification, and alternative investments all fit together.